Welcome to the Agent of Wealth podcast with Marc Bautis from Bautis Financial. In this podcast, Marc helps guide you towards financial freedom, ensure you never run out of money, and create a balance in life that prioritizes what is most important to you. Join us for this journey as Marc draws from years of expertise and guest experts to solve the multiple wealth building challenges involved in your financial life.
Welcome back to the Agent of Wealth. This is your host, Marc Bautis. On today's show, we're going to talk about things you should consider with financial planning before the end of the year. I like to send out checklists, or actually I have a couple of different checklists that cover some financial planning items that have December 31st deadlines attached to them. The checklists have both things that have a December 31st deadline, but also things to consider at least annually. So while you're looking at things that you have to do before December 31st, it makes sense to look at some other different things with financial planning related as well. But on today's episode, what I'm going to do is I'm going to cover some of these areas, not all of them, just because the exhaustive list, one, it's not applicable to everyone, but also we would have a 3-hour podcast going over everything. So we'll cover as many as we can, but the main message of this podcast is there's certain things that you should look at when it comes to financial planning by the end of the year. A lot of people either get wrapped up in the holidays and forget to look at them, or kind of put it off until the next year when their taxes come up. But, I was talking to someone, and we actually sent out a newsletter recently called What to Do to Prepare for Tax Season. And I got some responses that said, well, isn't tax season in April? Sure, you gather your documents, you fill out your tax return in April, but most of the things that you can do to better your tax situation have to be done by December 31st. So keep that in mind while we're going over some of these things. So in the asset and debt category, one thing to consider is, do you have any unrealized investment losses in your taxable accounts? So one thing you can do is you can actually realize a loss or investment loss, which means you actually sell the investment. So when a gain or loss is unrealized, that means there's no taxable consequence. But when you do sell it, the IRS looks at what you sold it for versus what you bought it for, and you either have a gain or you have a loss. If you have a gain, you owe tax. If you have a loss, you can deduct tax or make it look like you earned less income for the year. So the way it works is, if you do have a loss on your tax return, you can write off up to $3,000 against ordinary income. Let's say you have $10,000 worth of losses. You don't actually lose the $7,000 that's above the $3,000. You get to carry it forward to the next year. So it's not lost even if you have more, but there are a couple of reasons why people would do this. One is obviously to get that $3,000 write-off. Two, if you want to offset any capital gain. So let's say you've sold something in the beginning of the year and you realized a gain of $10,000. If you have something that you can sell for a loss, it would actually negate up to whatever that loss is, that gain that you had. So there is no limit on that. So even though there's a $3,000 limit on writing it off, you can offset any gain by a capital loss. One other thing you also want to keep in mind too about gains and losses are there are some mutual funds that fall under this active category, where what they do is towards the end of the year, they distribute their capital gains. So you didn't necessarily sell any shares of the fund, but within that fund, there's a fund manager who's buying or selling things throughout the year. And if they have gains throughout the year, those gains get pushed down to you, and you'll owe, as a mutual fund holder, you'll owe tax on those gains. Now, a lot of times you'll see these in active mutual funds, and this is one of the reasons why things like ETFs have gotten more preferable over the years. And they're active ETFs. So I'm talking about the passive flavor variety, because they're passive, they track an index. And sure, there are changes to the index. Those changes don't happen that frequently. So less of a tax burden that you probably have within that ETF. Another thing to consider is, are you subject to taking RMDs, which includes from inherited IRAs? If you are, those RMDs have to be taken by December 31st. If you have multiple IRAs, you can aggregate them and only take them from one IRA if you prefer to do. Inherited IRAs can't be aggregated, so you do have to take those from each one. A lot of people will ask about, do I have to take an RMD from an employer retirement plan, most notably a 401k? And the answer is it depends. If you're still working, most likely you don't have to take it, although there are some caveats to that statement. But if you are retired and subject to the RMD, probably do have to take it from the 401k. On the tax planning side, one thing you want to look at, what do you expect your income to be in the future? If you expect your income to increase, one of the things you may want to consider is a Roth conversion. Two common instances where Roth conversions are beneficial. So one, if you think your income is going to increase in the future, therefore you are in a higher tax bracket, converting the traditional IRA to a Roth now can make some sense. Just playing this tax bracket game of what you're going to pay on taxes. And then the other instance where it may make sense is if any of the assets in your IRA have depreciated in value. So probably not any stocks or equities because they've had a run where they've gone up, but there is the potential you may have some bonds in your account that have either not gone up or gone down in value. And the reason why that may make sense is because you're converting it at a depressed price. So for example, if you have an asset, whether it's a stock or bond that you bought for $10 and is now valued at $100, if you converted it to a Roth, you're paying the tax on the $100 versus if you bought something for $10 and it's worth $1 now, you're actually paying the tax on $1. So I'm a proponent of Roth conversions. The other place you want to look at when it comes to Roth conversions are, do you have any, again, going back to looking at your income, is there any room in your current tax bracket bucket to fill up with Roth conversions? And the most common one, or the one I think that people should look at the most, is the 24 to 32% bracket. And the reason why is because there's a big jump versus like a 22 to 24% tax bracket. So if you did something that bumped you up into 24%, not as big a deal versus if you increased your income that bumped you up into a 32% bracket. And remember, when you get bumped up into a tax bracket, it does not mean that all of your income is taxed at that higher bracket. It just means that the income above the next lower bracket is taxed at that. So it's a progressive system. Looking at your income, if you are a business owner and you're able to accelerate any either expenses or income or push it off into the previous year, looking at your income can kind of help make that determination. And if you have that ability to do that. If you expect your income to decrease in the future, that's when you'll most likely want to either contribute to your traditional IRA, traditional 401k, versus the Roth option, just because you're getting the bigger tax benefit now. And then, going back to the unrealized capital gains, capital losses, you just want to know, do you have any capital loss carry forwards from prior years? So I mentioned that if you had $10,000 worth of losses, you can only on your tax return write off $3,000. The $7,000 doesn't get lost. It goes to a future year. But a lot of times it gets lost or people just don't know, what do I have in carry loss forwards? That can help you make that decision of, do I need to or should I sell anything this year for a loss? So you just want to be aware of that if you have any loss forwards, and that would show up on your tax return. Now, under the tax planning things to consider, if you're charitably inclined, it's a December 31st deadline to make a donation or a tax-efficient funding, where you can do a lot of the popular ones are a qualified charitable donation out of an IRA or a qualified retirement plan. Some people like to gift appreciated securities and do that charitably. Helps you save on taxes. The other thing to consider, if you're expecting to take the standard deduction, which is $14,600 if you're single, $29,200 if you're married filing jointly, you may look into bunching your charitable contributions or contributing to a donor advised fund every other year. And the reason for that is 1 year you would take the standard deduction, the next year you would itemize, because charitable donations are an itemizable. That's one thing. That's a strategy called bunching. You want to look at anything that happened throughout the year or that may have happened or that may happen that would impact your tax liability. So that might be something like an inheritance, or if you took a distribution from an IRA and you didn't have tax withheld, or if you have restricted stocks that are vesting or options or a bonus coming at the end of the year. You just want to look at your tax withholdings and make sure that you understand what the tax liability is. And obviously, if you have a decision to make, what are you going to decide to do based off of what the tax impact is? If you are making a 401k contribution, it's a December 31st deadline. I actually just released one part of a multi-part series on 401ks. The first thing off the bat is you should, if your employer offers a match, you should at least be contributing so that you get the full match. So if you haven't done that throughout the year, now is a good time to do that. And actually, any like your employer or your employee contribution, that's December 31st. So that you do have to get in by the end of the year. If you own a business, you don't have a retirement plan in place, but it's something you want to consider for the following year. There are deadlines in this year that you have to abide by if you want to have a special type of retirement plan called the Safe Harbor Plan and have it eligible for a January 1st start date. So if you own a business, you don't have a 401k plan, you're considering it, something to think about. One thing you also want to think about, are you able to save more? And there are a couple different places to save. You want to look at them from different aspects, like which one will give you the most tax benefit, which one, if you do need the funds at some point in the future, where are they most liquid? And then obviously there's savings and what are you actually allocating it to, or what investments are inside it, or if you're saving it, what is the return you're getting on and the risk you're having to take on that savings. So a couple of things to consider: if you have an HSA or a health savings account, you may be able to contribute or $4,150 if you're single and $8,300 if you're a family. And the reason why I mentioned HSAs first is they have that triple tax benefit of you get the deduction. The money comes out as long as it's used for healthcare expenses, tax-free, and you defer paying tax on any of the gains in the account. So that's definitely one way. That is your 401k and savings that we talked about. And you can actually save up to $23,000 into a 401k. You can really save a lot of money into the plan. So it's definitely something, if you're behind on your savings, where you can catch up pretty quickly if you start saving big chunks to it. If you have a 529, or if you want to start a 529 and want to contribute to a 529, if you want to make it a 2024 contribution, it's a December 31st deadline. What you're able to do is you're able to contribute up to $18,000 per year per beneficiary to a 529 account, and that is considered a gift, and it's a tax-free gift if it's under that, with every other gift that you gave to that same person if it's under the $18,000. But alternatively, you can make a lump sum contribution up to $90,000 to a beneficiary's 529 account. And the way it works is it's actually considered a 5-year gift, and that again is tax-free. A lot of people would ask, well, what happens if they don't use the 529? There are different options, and it's becoming more and more usable in the event that it's not used for education. And what I mean by that is unused 529 funds may be able to go to a beneficiary's Roth IRA. So there's some rules and limitations that apply to that, but that's a great place to, if you can't use the 529, what you can do with the funds in there. On the insurance planning side, you want to look at, if you have a flexible spending account or an FSA, you want to look at, do you need to utilize any funds that are in that FSA before the end of the year? Some companies will allow a certain amount of unused funds to be rolled over to the following year. Some companies offer a grace period where you have to use those unused funds by a certain date, like March 15th. Some will give you 90 days to submit your receipts from the previous year. But one thing is, understand how your FSA works and if you have any unused funds in there and you need to use them. Another thing on the insurance side is, did you meet your health insurance plan's annual deductible? And again, this is like sort of what I was talking about with your income and accelerating income. If you've met the deductible, you may want to try and use medical services that you know you need before the end of the year versus starting in 2025 when your deductible starts up again. On the estate planning side, has there been any changes to your family, your heirs? Have you bought any, sold any assets that need retitling? Do your beneficiaries need to be changed because of a divorce, a marriage, a new family, kids? Do you need to make any gifts? Again, going back to that $18,000 per year that can be donated gift tax free. And just one thing on that, a lot of people think, well, if I go over $18,000, does that mean I'm going to have to pay tax on this, on my 2024 taxes? The answer is no. The way it works is, everyone has a lifetime gift exemption. Your $18,000 a year doesn't eat into that exemption. If you go over the $18,000, what it does is it eats into the exemption, but you don't owe tax today. It gets tracked, and every year that you make a gift over the $18,000, you have to include it in the tax return. It gets tracked, but you do not owe taxes on that in that particular year that you do owe it. The way it works is, what happens is, when you do die, they'll look at the assets that are a part of your estate and that are getting passed on. They'll look at if you did utilize any of that gift tax exemption throughout your lifetime. And as long as you're still under it, there won't be any tax that's owed. If you are over it, then there would be a state tax that would be owed on. Currently, the lifetime exemption is high. It's over $13 million, and that is subject to change because it's fluctuated throughout the years. There's been different changes where it's been it's been a zero, it's been as low as $1 million, and I think now is where it is. It might be at the highest that it's ever been. If you're looking at all this stuff for year-end planning, you might as well look at some of the other stuff. So you want to look at your investment strategy. Has anything changed throughout the year or changed with your situation where you may need to change it? So for example, maybe you had this investment account where you were very aggressive and all of a sudden you decide that I'm going to need that account to go buy a house with in 2025. Well, maybe you want to change your investment strategy so that in the event something negative happens with the investments, when it's time to go buy that house, the funds are still available. If you have any children in high school who plan to attend college, depending upon when they're going to apply or when they're going, is there anything you can do with the FAFSA or with your income so that how you look on the FAFSA may make you more eligible for financial aid? And then the other thing to consider too is you want to look, will any new laws go into effect next year that may impact your overall financial plan? Things are changing all the time. So some are big sweeping changes with taxes and with different finances, but then some are little changes that somewhat fly under the radar, although they're there and they go into an effect. So you just want to look and see, is there anything that I need to be aware of that may impact me specifically? People are different. Some people like to look at their finances throughout the year and they like to break things up in little chunks. So they might say, okay, in the first quarter, I'm going to tackle some estate planning things. I'm going to look at my investment strategy. Second quarter, I'm going to look at taxes. I'm going to look at my savings. And, they'll have something for every quarter. And then there are other people that say, you know what, I have a little bit of downtime with the holidays or before the holidays, or I just want to look at some of the stuff towards the end of the year and I'm going to do all of it. I'm going to bunch it up and go through everything. No right or wrong. It's really however you want to do it, as long as you are looking at it at least annually. The reason why we had this podcast or look at it today is just the December 31st deadline does impact a lot of things. And I've seen a lot of times where people would start their January planning, but some of the things that they want to do, they were things that should have been done the previous December. So you just want to get ahead of this by going through this checklist. What we'll do is we'll link to this checklist in the show notes. If you go through it, you have some questions on whether something is applicable to you or not, or just in general questions, feel free to set up an appointment at bautisfinancial.com/call. And thank everyone for tuning in today.
Don't forget to follow the Agent of Wealth on the platform you listen from and leave us a review of the show. We're currently accepting new clients, and if you'd like to schedule a one-on-one consultation with our advisors, please do so at bautisfinancial.com/call.
Thank you for listening to the Agent of Wealth podcast. Click the subscribe button below to be notified when new episodes become available. The information covered represents the views and opinions of the guests and does not necessarily represent the views or opinions of Bautis Financial. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional financial planning and investment advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investments and financial planning.